Welcome back to Morning Trade Live. We're continuing to analyze yesterday's events with Liz Ann Sonders kicking things off for us this morning. Joining us, the Chief Investment Strategist at Schwab Center for Financial Research. Quite a session yesterday, Liz Ann. What'd you think?
Well, it was certainly wild. You had an initial reaction to the statement, and then a big rally off of that, and then obviously a pretty significant sell-off into the close. I think in terms of yesterday's action, it was more than just the Fed. You get those knee-jerk moves, but we also had the New York Community Bank news and some weaker, just general chatter around tech and tech-related earnings and AI, and whether maybe there's a bit too much hype embedded in the numbers. So I think it was kind of a witch's brew for ultimately a weaker day, but it was it was a wild one.
The just stark pushback with the market leaving March at basically a coin flip, despite what seemed to be some of the most explicit language I've heard from Powell, targeting a specific time and saying, hey, that's not our baseline, it's unlikely. What do you make of the market's kind of insistence still on that subject?
Well, I just looked now at the FedWatch tool, CME FedWatch tool, and you're at about 37% for a March cut. I think, frankly, I think that's even a little high. I think Powell was pretty clear yesterday, and I think a condition under which the Fed would actually cut rates in March, I would just say be careful what you wish for, because I think he made it perfectly clear that it would probably require pretty significant deterioration in the labor market in order to trigger a more aggressive move in terms of not just the timing of rate cuts, but the number. And that, on that note, that's what's kind of interesting with the adjusted expectations for maybe a May start or even a June start versus a March start, is you still have the market pricing in 5 to 6 cuts. So the way the market thinks of it now is that the Fed will just start later, but then they'll have to be a little bit more aggressive. I'm not sure that's the best read either. I think you and I may have spoken about it on a prior program, but I think what's unique about this cycle is, unlike the normal cycle where it's often said that the Fed takes the escalator up and the elevator down, it's very clear they took the elevator up this time with such a dramatic tightening cycle and multiple hikes of 50 to 75 basis points. I think their bias is to be maybe a little bit more gradual on the downside, again, barring a significant amount of deterioration in the economy broadly or the labor market specifically. But it certainly does put the spotlight on tomorrow's jobs reports, even more so than would otherwise be the case.
Really seems then that on the margin in the next month and a half, the data that we're going to get, if it still plays a role in that March decision, then it's really going to be about determining if there's significant continuation, because he did make it pretty clear that we're on the right path. They just want to see more of it. So if we do get prints below expectations or at expectations for CPI versus jobs at expectations or below, kind of walk me through what could change, you think, Powell's mind in the data that we've got over the next month and a half?
Well, he was pretty specific in citing the labor market as key to the start point and the speed with which they move to rate cuts. And that had been our perspective, in fact, illustrated in our 2024 outlook, where we felt that labor market, basically the other part of the Fed's dual mandate aside from inflation, would come into clearer focus for them and be more of a driver of their decision making on the easing side, whereas it was mostly just inflation that was the driver of their decision making in their rate hiking part of the cycle. So I do think that doesn't mean that a continued string of disinflation isn't important in their mind, but I think the needle mover may rest a bit more on the labor market in both directions, meaning that if you get, say, a string of hotter than expected labor market readings, particularly in the components that the Fed views as driving inflation, like the wage components, then I think that could be more of a mover in terms of probability changes via things like the CME tool, whereas last year it was mostly just about the inflation readings coming in.
Okay. So the data for jobs, walk me through kind of your expectations for tomorrow, and then from there, because we did get a little bit of a miss for the number this morning for jobless, and then ADP was kind of soft. Yep. So 2 out of 3 this week, maybe not terribly strong.
And even last month's jobs report, which was for December, had sort of more meat on the bones under the surface than what you just picked up by looking at the headline readings on payrolls, which were better than expected, and the unemployment rate, which didn't move up. But you saw that huge differential between the establishment survey that generates payrolls and the household survey that generates the unemployment rate. And the reason why the unemployment rate didn't go up was because of a huge drop in household employment and a nearly commensurate drop in labor force participation. So it was a non-move up in the unemployment rate for not the best reasons. You saw hours work come down again. So that's what I'm going to focus on as much as the headline readings on payrolls and the unemployment rate is the innards of that number, that differential between payroll and household. Whether we get yet another downward revision, if we do for December, it would mean that every month in 2023, with the exception of July, had payrolls downwardly revised. I'll also look at what the makeup of job creation is, because most of the job creation in the last several months has been in non-cyclical segments of the economy, in areas like education and government employment. And those cyclical areas, if you start to see deterioration, that is an embedded sign of what's actually going on in the economy that you wouldn't necessarily pick up if you stopped your analysis at the headline level. So that's what I'm focused on when we get the report at 8:30 tomorrow.
You had a good chart that I thought was an interesting look on the margin of some of the softening a little bit in the economy by way of job stayers versus leavers. The rate that job changers were getting to jump throughout the last couple of years was significantly higher. That gap has closed a bit. It feels like that's a pretty good indication on the margin of how things have loosened up a little bit.
Oh, no question about it. And that had been an extreme, and it was really tied into the narrative, which had a lot of validity to it around the incentive for people to voluntarily quit their jobs. It's why you hit a record high quits rate. And it is one way to see, as you see an easing in that ability to just jump with confidence to find another job, and not just another job, but at a higher wage range than where you were before. And it's not a surprise to see that narrowing. It's consistent with some of those other underlying signs of some cracks in the labor market. By the way, not necessarily a bad thing in terms of what the Fed wants to see. They're trying to bring some tightness out of the labor market, bring the quits rate down, bring down job openings without crushing the job market. And on that note, so far so good. That's the needle that they're trying to thread, is to loosen the labor market without really trashing the labor market. And that's why you have to look at some of those other metrics like openings and quits and, stayers versus leavers, wage differential.
Okay. So there's no secret that things have softened up a bit, but they're still at generally pretty good levels. Curious your thoughts on the renewed bank scare yesterday, the sell-off in KRE. I mean, the market definitely responded to one single story. Maybe also keeping the bond market bid. It certainly did early in the day. Do you think that has any indication of weakness in the economy?
Well, I've heard the word, yet again, idiosyncratic to describe what happened with a New York Community Bank yesterday, given that their purchase of assets in the aftermath of the failure of Signature Bank brought their balance sheet up to a level that changed their regulatory requirements. But of course, also within that report was concerns about commercial real estate. And you are hearing more chatter about that. We've had the view for quite some time that commercial real estate is still very much a problem through the windshield. It's certainly not in the rearview mirror, but it's not likely to be Lehman-esque in the sense that it represents some moment in time, whether it's, varying exposure levels, a type of exposure different companies have specifically in the small and regional banks, and then probably most importantly, what the maturity schedule is. But I think it brings it back to the forefront of analysts' minds and portfolio managers' minds. And now we're at the point where any exposure down the cap spectrum into that small and regional bank area is going to require a pretty fine-tooth comb analysis of what that commercial real estate exposure looks like, what components within commercial real estate, which of course is a very big category, what that maturity schedule looks like, and what the health of the underlying balance sheet is, and the ability to kind of ride through that maturity schedule. So I'd say one note of caution: don't look at financials more broadly, but even specifically down into the small and regional banks with a monolithic lens.
All right, great stuff, Liz Ann. Thanks a lot for being here.
Good to see you.
Liz Ann Sonders, Chief Investment Strategist at Schwab's Center for Financial Research. All right, we had all the big stuff from yesterday.